If you have $100,000 sitting in cash right now, leaving it there is a guaranteed way to watch it slowly lose its buying power to inflation. To put that money to work in Australia, you're usually looking at one of two major vehicles, the stock market or residential property. It's tempting to pull out a calculator, compare historical return percentages, and pick the higher number. But that completely misses how these investments actually operate in the real world. What you are really deciding between is frictionless capital efficiency on one side and leveraged asset control on the other. Whichever route you take will dictate your risk exposure, your weekend admin, and your overall lifestyle for the next 20 years. Let's look at the starting line. With an ASX index fund, your entry cost is essentially zero. You transfer $100,000, you pay a couple of bucks in brokerage, and that entire six-figure balance goes to work immediately. This chart shows exactly why real estate doesn't work that way. With $100,000 in cash, you aren't putting $100,000 toward a deposit. A large chunk of your capital gets sliced right off the top. Before you get the keys, you have to clear stamp duty, conveyancing fees, building inspections, loan establishment costs, and depending on your loan size, lender's mortgage insurance. These unrecoverable expenses easily chew through $25,000 to $30,000 of your initial capital. You are left with about $70,000 to actually use as a deposit. Buying property forces you to start tens of thousands of dollars in the red. For this trade-off to make sense, real estate requires a massive structural advantage later on to justify that harsh entry penalty. History shows that $100,000 dropped into an ASX 200 index fund returns roughly 9 to 10% per year when you include dividends. The Australian share market also has a distinct feature that juices those returns even further, known as franking credits. Because Australian companies pay tax on their profits before distributing them to shareholders, you receive a credit for the tax they already paid. This directly boosts your after-tax dividend yield. Let that compound. $100,000 growing at 9% per year for 2 decades turns into roughly $560,000. If you add just $500 a month into that same fund, a strategy called dollar cost averaging, you smooth out the market bumps and push that 20-year total well past $900,000. It requires zero debt, no late-night phone calls from tenants, and almost no maintenance. But this passive machine has a hard mathematical ceiling. It only grows the cash you possess. This is where property investors utilize a structural advantage that flips the entire debate. It comes down to leverage. This diagram illustrates how that remaining $70,000 deposit operates. You don't buy a $70,000 asset. You use it to secure a bank loan, taking control of a $500,000 asset. Historically, Australian property grows at about 6 to 7% per year. On paper, that is lower than the stock market's 9% average. But that 6% growth isn't applied to your $70,000 deposit. It's applied to the entire $500,000 value of the property, creating a $30,000 gain in year 1. When you measure that $30,000 against the cash you actually put in, you are looking at nearly a 30% return on your initial money. Leverage acts as a mathematical accelerator. By growing a massive pool of the bank's money alongside your own, your net equity can outpace stock returns, even if the baseline growth rate is lower. But using $400,000 of someone else's money brings its own harsh operational reality. You have to service that debt. Your rental income is immediately attacked by high cash rate interest payments, council rates, landlord insurance, and property management fees. Once you subtract those holding costs and maintenance, your cash flow often turns negative. This scenario, where the total expenses exceed the rental income generated, is known as negative gearing. Currently, Australian tax law allows you to claim those specific losses against your taxable income, cushioning the financial blow. But relying on tax policy introduces obvious regulatory risk. The government is actively modeling changes to wind back negative gearing and reduce the capital gains tax discount. If those go through, the financial math for property investors tightens up fast. So while leverage mathematically accelerates your equity, it extracts a heavy toll in daily cash flow pressure, debt anxiety, and exposure to legislative whims. The stock investor sidesteps all of this entirely. The greatest threat to the index fund investor isn't market performance, it's extreme liquidity. The fact that you can sell shares on a Tuesday morning and have cash by Thursday means your exit strategy is always just a few clicks away, which makes it dangerously easy to abandon your plan when things look grim. When interest rates spike or global headlines turn negative, the temptation to exit is constant. Retail investors consistently let emotion override logic, selling at market bottoms and vastly underperforming the very indexes they invest in. Real estate offers a powerful defense against this exact behavior. It is incredibly difficult to sell quickly. A mortgage acts as an automated mechanism for forced savings. You cannot panic sell a house at 2 in the morning because the market dipped. The physical scale of the asset, combined with a 30-year debt contract, forces you to hold on through market volatility. A theoretical maximum return on a spreadsheet is completely useless if the asset doesn't physically or psychologically prevent you from abandoning your strategy when things get tough. This chart boils the debate down. Are you optimizing for frictionless freedom or maximum net worth acceleration? For geographic mobility, zero debt anxiety, and free weekends, take the index fund route. To manage tenants, stomach borrowing costs, and control a larger asset, choose property. But the blueprint for scaling your net worth often involves tackling maximum complexity. You use the leveraged equity generated by property over time to eventually fund a liquid, dividend-paying stock portfolio alongside it. The math matters, but the only objectively wrong choice is deploying your capital into a system that directly conflicts with your lifestyle and your tolerance for stress.